This is the 2016 FCC Farmland Value Report. Our report covers the January 1st to December 31st period. I'm not going to describe our methodology in great details, but we use benchmarks that we appraise at the end of the year, and we tend to keep the same benchmarks every year. So that gives us an idea of how land values in each of the 51 regions, which is a very nice feature this year. I'm absolutely thrilled to be doing this, is to be able to report results at the regional base, at the regional levels instead of just the provincial numbers. So we have benchmarks located across the country in all of the regions, and so we have raised these benchmarks, and also we validate whatever result we come up with actual sales data. So a subset or a sample of actual sales data in 2016 and 15 that allows us to validate the benchmark approach. So we feel very confident about the results that we have. As I said, this year, for the first time, we are reporting results for 51 regions. So on top of the 10 averages for each of the provinces, we report regional results as well, which is very exciting. So these are the results at the national level. You have the provincial average increase between 2016 and 15, and so that adds up to a 7.9% increase at the national level. It must be emphasized that this is a weighted average, so the more acres you have in a province, the bigger the weight of this province is going to be in the average. So, for example, the province of Saskatchewan would have more weight in the national average than the province of P.E.I. Having said that, it all adds up to 7.9%. Largest increase is or was in P.E.I. at 13.4%. The smallest average increase has been in Ontario at 4.4%, but Ontario has actually reported quite a few increases in years past, and so this is absolutely, I would say, to be expected to see that declining rate of growth in farmland values. One of the things also I need to emphasize is that for the third successive year now, we have a declining rate of growth in farmland values. So that's the third successive years in Canada that we have the national average come down, or that farmland values are still increasing, but at a slower pace in some provinces. Ontario is one, Quebec is another. We have 4 consecutive years of slowing pace farmland value increases, and we'll get to the reasons as to why and all that later on. As I said, we are able now to report results at the regional level. So for each of the provinces, we can actually break down a few regions and understand what are the trends within a province. I'm not going to be able, obviously, to cover all 51 regions in this webinar. I'm going to show you some map. The report itself is available to be downloaded on our website at fcc.ca. You'll get a lot of details. You'll get all the maps that I'm showing you today, as well as a bit of insights as to some, or at least one of the drivers in each of the regions. So that gives you a little bit more insight that I'm going to be able to cover today. Really today, I want to emphasize on some of the broad trends that I'm finding in the marketplace. If we start with Atlantic Canada and we look at the regional level or the regional results, we have a fairly homogeneous type of outcomes here within the province. So if you look at Nova Scotia as well, fairly consistent and similar type of increases you'll find in Nova Scotia. P.E.I., Prince Edward Island is much of the same. New Brunswick is showing a bit of variability, but we only have 3 regions, and 2 of the regions are actually showing no increase. Note that out of the 51 regions we have, at the national level, 7 out of the 51 actually recorded no increase. We did not record a region with a negative change in farmland values on average, but we have 7 of the 51 regions that are actually showing no increase at all. And we didn't have enough transactions in Newfoundland and Labrador to actually come up with an estimate this year. But we have been in the past, but not this year. Moving into the center of the country, if you look at Ontario, Quebec, and Manitoba, we have a bit more variability. That's certainly the case for Quebec, where we have more variability, 7.7% average, so in line with the national average. But within the province, a lot more variability that you'll find perhaps in some of the provinces. Ontario actually is showing a bit more, a bit less, I would say, variability within or across regions, and Manitoba is showing a bit of that variability as well. Quite a bit of a strong increase, for example, in Manitoba, the Central Plains, Pembina Valley at 11%, quite significantly higher than the Eastern region, located right next to it at 4.3%. So again, farmland is a local market. A lot of the local drivers will have an impact on top of some of the broad global drivers of farmland values that I'm going to address later on. And also some of these specific details are actually in the report itself that can be downloaded from our website. So finishing up the tour out west, looking at Saskatchewan, Alberta, and British Columbia. Again, a bit of variability, especially in Saskatchewan, I would say, where the province can be divided into west and east, and the three regions out west are showing more of an increase that you'll find out east. I think to me, I find this interesting if I can spend a bit of time on Saskatchewan, because if you look at the reasons why you have a bit more of a stronger increase in the western side of the province compared to the eastern side, I think it speaks to sometimes what you'll find in the marketplace is actually not function of what actually happened, but more function of what expectations are going into the year, right? So if you think of early 2016, there was quite a bit of optimism in terms of the post-crop markets and lentils, for example. It turned out that we had some quality issues, some production challenges as well because of weather. So all in all, maybe the year was not, at the end of 2016, the year was not as expected going into the year. And I would say a lot of the optimism and positive expectations about what 2016 could look like, I think had a bit of influence on the results in Saskatchewan and not the actual data that I'll show you in just a second. In British Columbia, also one of the things that I find interesting is that it's one of the few provinces, if not the only province, in which you have a rate of increase in British Columbia for farmland values that is actually going up instead of coming down, as I said, for most provinces. Part of the reason is that unlike all the other provinces between, I would say, 2006 to 2012, 13, we had quite a bit of stability in British Columbia, whereas in other provinces, you've seen some growth. So it's a bit of the market rebalancing, I guess, in some cases. And so it's quite a few strong increases in British Columbia. And in Alberta, despite an ongoing slowdown in the energy sector, you still have strong increases in farmland values on average, and I think it speaks to the resiliency of the farm sector. So we'll talk about that later. So those are the results. As I said, I wanted to spend as little time as I could because all of this is available on the website. But just to dive a little bit more into some of the drivers behind farmland value increases, I always like to start with this. Those are farm cash receipts at the national level. What I think is worth noting is, first of all, I mean, if you look on the far right, the two bars that are what appears to me red anyway, could be brown, could be orange. Those are forecasts. So 2016 is technically still a forecast. We don't have yet the final data. We're missing just a few months. So we're actually quite confident about the forecast, but technically it remains a forecast. And 2017 is obviously a forecast because we just don't know what the 2017 crop is going to look like yet. But what you find is between 2005 and 2015, we had quite a bit of growth in the farm sector. If you look at the farm cash receipts, especially on the crop side of things, we did have growth on the livestock side of the market in terms of livestock cash receipts. But if you look at crop receipts, this is really where the growth has been. We've been basically adding $2 billion worth of farm cash receipts on average on an annual basis for 10 years. $2 billion more every year on average for 10 years. So that's the growth that we've seen in the marketplace. And a lot of that growth has been because of higher production, but also because of higher prices. And so we have to wonder now, we have to think about what kind of pricing outlook is there out there for Canadian crops. And we'll talk about that in just a second. As I said, I can't go into the details of all the provinces, but I'm going to pick two. I'm going to pick Saskatchewan and Ontario. And the reason why I'm picking these two is that all the provinces can fall into one of the two. Basically, Manitoba and Alberta will be quite similar to what Saskatchewan looks like, Quebec, BC, and some provinces in the Atlantic will be quite similar to what Ontario looks like. So I guess, by looking at Saskatchewan that looks, with Alberta and Manitoba, I think represents one type of situation, and whereas, if you look at Ontario, you have the other possible type of a situation. So that's what I'm going to do over here. So this is crop receipts, and I'm always asked, is farmland overvalued, undervalued? I guess it's more, the question is more about being overvalued than undervalued, quite frankly, for reasons I'm sure you're all familiar with, but because of the recent increases we've seen for the last few years. My answer is always about, what kind of outlook do you have for crop receipts? We looked at it a number of different ways. No matter how you look at it, it really boils down to, are we going to be able to sustain the level of income that we've had over the last few years? So this is a picture for Saskatchewan crop receipts. Tremendous growth. We more than basically more than tripled crop receipts over 10 years. You look at 2016 and 17, 2016 is actually a little off for the record year in 2015, a bit of a decline of 4 or 5% we're projecting for the year 2016, partly because of quality issues, partly because of some production challenges as well. 2017, some stability. So we're basically saying, hey, we're going to be, based on what we know about what futures markets are telling us, about what we expect production to look like, about what our assumption is with regards to the value of the Canadian dollar, we expect to be able to sustain farm or crop receipts in Saskatchewan. So what does the picture look like when you look at crop receipts as well as farmland values? A number of different things are happening here in this chart. And so I think it's worth taking a little bit of time to understand what's behind this chart. You got the average value. So we're using Statistics Canada average value of farmland on a per acre basis, and we apply our percentage increases from the FCC Farmland Value Report. That gives you the blue line. The blue line is the increase, or the average increase in farmland value, or from 1992 all the way to 2017. 2017 being a forecast. If you look at our forecast for Saskatchewan when it comes to farmland value, we project an increase between 3 and 4% for Saskatchewan. So we're basically cutting in half the rate of growth we've seen in 2016. And what we do is we lay on top of the farmland value trend, we lay on top of this the trend in crop receipts on a per acre basis. So a lot of different calculations as well. We're using all acres, not just acres related to crops. And so the figure there, if you're a grain and oilseed producer, you may be thinking, well, this is too small. Well, yes, it is too small because we're using all acres in Saskatchewan. And the reason we're doing this is because of data issues. And I don't want to get into the details, but we're limited with how we can use the data. And so we're using all acres. So this is why the number actually looks a little bit smaller than what it really is if you're a crop producer. But the pattern or the trend is not going to be influenced by this. So what you really want to look at or pay attention to is the trend in these two lines, basically. And we see that actually crop receipts, I would argue, have actually climbed faster and sooner than farmland values. So when we think of Saskatchewan, there's been a bit of catch up, that the market displayed with regards to where crop receipts were headed. And right now, we're basically saying a bit of a dip in 2016, some stability moving forward in 2017, and you see the rate of growth in farmland values that is stabilizing. And so over the course of the next few years, we expect that to be fairly stable. If, that's a big if, and we'll talk about what is the risks to the what are the risks to the outlook actually, but if we are able to sustain crop receipts. So the question of whether or not farmland is overvalued or undervalued and so on, to me, goes back to what do you think the outlook is for crop receipts? And if you believe that we're going to be able to sustain crop receipts where we have them right now, I think the outlook is fairly secure, and I would say we'll be able to sustain the farmland values we have in the marketplace right now. Now, let me shift over to Ontario, because I think Ontario is in a bit of a different situation. And I would say Alberta and Manitoba would be a little bit more similar to Saskatchewan than they would be for Ontario. And I would say the provinces in Atlantic Canada would be a bit more similar to what you'll find in Ontario. Ontario, we have a bit of a different trend when it comes to crop receipts. We got increases, significant increases, but some stability really since 2012. That was the year of the drought in the U.S. with low corn yields and high corn prices. And we've seen basically we reached a record high in 2013 when that 2012 crop was marketed. And we've been able to sustain that level, that record high value, a little bit lower perhaps, but nevertheless, we've been able to sustain and basically because of some of the pricing in futures markets, we expect that to be sustainable. If you were doing the same exercise and look at crop receipts on a per acre basis, which is my brown or red line, and you compare that to that farmland value line, you'll see that the pace of increase in farmland values has somewhat outpaced a little bit crop receipts. Now you have to be careful, and so the box that is dotted or in black, that little rectangle there is just to highlight that this is a forecast, because technically, as I said, we don't have yet 2016 crop receipts, and our 2017 farmland value increase is a forecast. We're projecting something in the range of 2 to 3% in 2017 for Ontario farmland values, and you see that stabilizing. And I'm fairly confident that we'll be able to sustain those values if indeed we're able to sustain crop receipts. And I think that's really the key moving forward is if we're to see a drop in crop receipts like the one we've seen in the US, then that could perhaps trigger some small declines in farmland values over the course of the next few years. But as long as we're able to sustain this, and I'll go and address the factors that I believe are critical to monitor when it comes to being able to sustain crop receipts. If we're able to sustain crop receipts, I see no reason why we're not able to not sustain farmland value increases we've seen in the marketplace. So, but is it something to worry about? I would say no. Is it something to monitor? Definitely. Definitely monitor the pace of the strength in crop receipts compared to where farmland values are going. I think that's really the key moving forward. Now, talking about this, then we have to look at the grains and oilseeds market. And really, I think if I were to summarize, and this is not going to be a market outlook at all, but I'm just going to summarize what I find important in the marketplace right now. I would summarize this with that we have strong upward production trends, and that's on a global basis as well. It's not just in the U.S. We got a big crop coming out of South America. Some perhaps mixed outlook for East European and some Asian nations, but nevertheless, I think it puts the spotlight on the strength of demand, because with those big crops, we need to have really strong demand, as well as weather going into the 2017 year, right? So because of the idea that we have global supplies that are increasing, I think the market's going to be a little bit volatile in terms of saying, hey, maybe we need to pay attention to what the crop's going to look like in the US a little bit more than usual. Because if we do have a good crop coming in from the US, perhaps that could actually bring a bit of pressure on prices. So if I go and look at, for example, the stock to use ratio for corn, again, not necessarily have the data here today for all the commodities, but corn's a good bellwether, so to speak, of what is going on in the grain and oilseed markets. Actually, we have 2017-18, so anticipating where the 2017 crop is going to look like and anticipating the strength of demand, we have that ratio coming down for the first time well, actually, I'm not going to even count the 14 to 15 small decline that we've seen. So we have a decline for the first time in a number of years. That's partly driven by the anticipated lower or decrease in the corn acreage that the market's anticipating for the US in 2017. So I'll speak to that as to why we're finding this. What is driving decisions of producers is anticipated profit and the expectations of profit margins that they can derive from the 2017 crop. The outlook, and so this is Ontario profit margins. I'm going to look at prairie profit margins in just a second for wheat and canola, but for corn and soybeans, if I'm focusing on Ontario first, you see that it's a lot tighter market for corn compared to what it is for soybeans. So there's a lot more upside for the oilseed market, and hence the reason why the USDA in their most recent report expects that corn acres are going to go down by 4% in the US and soybean acres go up by 7%. I always say never count corn out too quickly. It tends to be that, well, if you look at the recent years, last couple of years at least, it always been the case that actual acreage have been higher than what was projected at the end of March, which is the most recent report of the USDA. So be careful about this, believing that we're going to indeed get a drop of 4%. We don't get to that 4%, perhaps we're going to get even tighter margins. A drop less than 4% would bring margins down a little bit, would bring prices down and then bring margins down. Now, this is in Canadian dollars. As I said, this is thought to be representative of a producer in Ontario. Again, a lot of assumptions go behind this, among which the value of the Canadian dollar. If you had the same picture for a producer in the US Midwest, you would find that corn, or the price of corn, anticipated price of corn, is below the cost of production in 2017-18. So producers yet not able to turn a profit for corn, whereas soybean is still profitable, but a lower profit than what you're seeing up here. Part of the reason driving the marketplace is really the Canadian dollar. Some of the, apologize for this, some of the, what we're seeing in the marketplace is that the downturn that we've seen in the US, we've been shielded from that because of the depreciation in the Canadian dollar. And the Canadian dollar plays a tremendous role, has a tremendous impact in the marketplace. I'll tell you why in a second, but our forecast for 2017 is for the US dollar to Canadian dollar to average 75 cents. So we're basically been running with this forecast for, I would say, certainly more than a couple of months. It's been our forecast for a while now. We think that there's very little upside for oil prices right now, despite some of the cutbacks in production by the oil producing countries. The US is still ramping up production slowly but surely. Demand's still strong, but having said that, we just don't think there's going to be any shortage of production. And so we expect oil prices to be roughly around $50 a barrel if you look at the US benchmark. And with interest rates moving up, yes, but there's not going to be a huge spread between interest rates in US versus Canada. We do expect Canadian dollar to average 75 cents in 2017. Now, let's think of the impact of that. And you can do the same exercise. I'll talk about wheat and canola in just a second here, but you could do the same exercise for rotation in the prairie. If you look at corn and soybean returns and you assume 75 cents like we do, that gives you the margins that I was showing. Here, I'm expressing everything on a per acre basis. But if it turns out that the exchange rate is not 75 cents, but the Canadian dollar does depreciate between now and the rest of the year, depreciates further than what we have already, and that the dollar goes to 70 cents, then this would be the impact on profit margins of a representative producer in Ontario. Again, some producers could have bigger yields, smaller yields, and that would give you a margin that's different than what you're seeing up on the screen. The important thing is really the trend and the margins. Now, and that would be positive. And some of the pushback. So I always say that lower Canadian dollar is good for business. Some of the pushback I get, and I understand fully the reason behind this, but some of the pushback is that, well, some of the inputs we pay are going to be priced higher. Absolutely right. Some of the inputs are going to be priced higher, but some of the inputs that you purchase are also priced or determined in the Canadian market. I'm thinking about land, first and foremost, labor, some equipment, and so on. So I would argue that, from a profit margin standpoint, a lower Canadian dollar is actually a good thing. So if you come down to 75 to 70 cents, it improves the margin. And if you go all the way to 80 and 85, that's when you see margins coming down. And so if you think of a threshold for which you'd say, I don't necessarily want the Canadian dollar to US dollar exchange rate to go there, I would say 85 cents US is perhaps the level at which I would say, hey, as long as it doesn't go to 85 cents, I think the outlook remains positive. If it goes to 85 cents, don't think it's going to happen. But no one knows for sure, obviously. So our forecast is 75. And if it goes to 85, this is perhaps when we're going to be thinking, okay, maybe there's something that we need to think twice, because that would bring quite a bit of pressure on margins. You'd have corn margins that actually be negative. You'd have soybean margins that would still be positive, but not as much. And that could be could put a little bit of pressure in. And as we've seen in the United States, that has driven some of the declines in farmland values we've seen, especially in the U.S. Midwest, where we had at least 18 months now of small but nevertheless declines in farmland values, and in some regions as much as 24 months of declines. And part of the reason, and I think we tend to, I think, underestimate the impact of the Canadian dollar in some cases. Part of the reason, if not the main reason behind some of the declines in the U.S., has been the decline in U.S. farm income, 20%, 10% last year. So farm income in the U.S. has come down, and we've been shielded from that mostly, not exclusively, but mostly because of the U.S. dollar to Canadian dollar exchange rate. So if I look at profit margins in the prairies, this is what it looks like. It actually looks quite similar to what 2016 was. You know, if you had shown you our picture for 2016, you would have seen a picture fairly consistent with this. Some tight profitability for barley, wheat. Durham's still showing a bit of profit, but it's, you know, there are some issues with Durham that may or may not, allow a producer to capture this particular margin. You know, and a bit of upside for canola. So again, it's on the oilseed side of the market that you're seeing really strong demand. There's pricing that is interesting. So that's going to be interesting to see how acres move into 2017. Part of the result of the actual profit margins in 2016 were actually lower than what you're seeing out there because of some of the quality issues that we've had in 2016, and in some parts of the prairies as well. We had some yield issues because of some acres that yet not harvested. So difficult, not necessarily a bad year. Some challenges in 2016 for sure. 2016, when it comes to profitability, some producers with a lower cost structure will be able to turn a slight profit when it comes to cereals. But oilseeds still showing a bit of profit, and that would be a good thing. I want to talk briefly about the strength of the overall economy, because it does matter as well, especially when it comes to interest rates. If I were to rank factors that are driving farmland values, I think crop receipts still number one, but interest rates, I would say come second. We've had low interest rate, low borrowing costs for a number of years now. But what I would like to point your attention to is really at the end of 2016. So the blue line you're seeing up here is the actual borrowing costs, an average of borrowing costs faced by businesses in Canada. So it's an average of all the different products that are out there. Think fixed rate, floating rate, short term, long term, and so on. Put an average of all the interest rates out there and come up with this one single measure. And what it says basically is at the end of 2016, especially in the fourth quarter of 2016, we reached a record low when it came to borrowing costs in Canada. We've never had borrowing costs on average in Canada being as low as at the end of 2016. And obviously, with low borrowing costs, it does increase the demand for farmland, and it leads to higher farmland value increases. Now, the second thing I would point your attention to is on the forecast on the far right of this chart. You have a forecast of borrowing costs slightly climbing in the first part of the year, all the way to mid-year, and perhaps faster increases towards the second half of 2017. So the one thing I believe is absolutely important for operations and managers and producers to understand is really that when we talk about the Bank of Canada rate, that's not the only thing that drives borrowing costs. As of last week, for example, the Bank of Canada released their monetary policy statement, and they basically emphasized that they did not change their overnight rate. And so if you have a loan in your book that is priced on the variable rate, that variable rate is off or based off prime rate, and prime rate being off the Bank of Canada rate, the overnight rate. So if the overnight rate's not moving, prime rate's not moving, and likely your variable rate, unless you have to renegotiate a loan that's coming due, that variable rate's not going to move. Having said that, that's one of the drivers behind borrowing costs. The marketplace is when it comes to financial markets is always up and down. And at the end of 2016, early 2017, you're seeing a bit of an increase, a small one, but that was driven by what was going on in the US economy. And we expect that there will be further increases in US interest rates as we move into 2017. So while we do not expect the Bank of Canada to increase its overnight rate in 2017, we do think that borrowing costs in general are going to be trending upward based on what is going on in the United States. Right or wrong, there's quite a bit of optimism when it comes to the US economy, and it tends to drive up interest rates in that case. So that remains to be seen. I think it's more likely to happen towards the second half of this year compared to what we're seeing up right now. Having said that, we do expect that to occur at the end of the year. Now, the one thing also, you have to put things in perspective as well. Even if we're right, turns out our forecast is right, you're still talking about basically at the end of 2017 going or reaching the point where we were at the beginning of 2016, which was historically low. Because if you were able to see past or before 2013, you would see that borrowing costs have been trending down in Canada for a long time. So you're still talking about historically low borrowing costs. This is not an argument for locking in versus letting it float. It's just an argument for business operators to actually be thinking about, all right, how much risk am I willing to leave on the table? And those are the variables I need to monitor. I need to pay attention not only to what the Bank of Canada says, but also to what is going on beyond the Bank of Canada rates. Think of bond markets, think of interest rates in general, because that will have an impact on my borrowing costs if I need to actually renew a loan or something like that. So it's something to pay attention to, and I believe that is something that is going to be more important towards the end of the year than at that current moment. Finally, just I'm getting towards the end of here, and so I'll be able to address the questions, and hopefully you this discussion has actually generated a bit of questions for a lot of you. We have secondary drivers as well that play a role. If you go in the northeast quadrant, and we got the oil barrels there. I mean, obviously, in some regions where that rely on the energy sector more than others, because of some of the slowdown in the oil sector, that wealth effect that you've seen in previous years, prior to 2014, prior to this slowdown in the energy market, well, it's not there anymore. And so that, for some regions, the slowdown in the energy market does have an impact when it comes to, wealth and or maybe a weaker demand than what we've for farmland than what we've seen in the past. Urban sprawl is always something that's pointed out as one of the drivers. I would say that if you look at our provincial numbers, national as well, you won't find an impact of urban sprawl on farmland value increases. But having said that, in some very specific regions, very localized impact, absolutely, it's not impossible to find something like this, especially in provinces like BC and Ontario. So yes, it does have an impact, but it's really very local and controlled and not having much of an impact on the overall results that we report on a provincial basis. And the other thing also, I did quite a bit of time I spent quite a bit of time on crop, or the outlook for crop receipts. The outlook for other sectors as well matters. I mean, we yet to have an expansion in the cattle sector, but we do have some businesses that are expanding on land base. It's the same kind of deal for poultry operations. And so in some specific areas, and hence the reason why I think it's so valuable now to have the breakdown of the increase by region and not just have it by province. Some of the sectors in some very specific cases can have an impact just on the basis that producers in this sector are having a good year. Turns out that they're more likely to purchase farmland. That drives up the demand for farmland and will drive up the price as well. So that is the presentation. The bottom line is that, hey, I still have a very positive outlook for ag. It's just that we have to be realistic about what the next 10 years are going to look like. And I would say that the next 10 years, while being, in my mind, likely to be very good years, are not necessarily going to be as good as we have had in the past 10 years. And because we've had tremendous growth. And so I think we have to have realistic expectations. The fact of the matter is that if we're able to grow farm cash receipts, especially crop receipts, that growth is going to be driven more by productivity growth than any type of growth resulted from pricing. And then I think some of that pricing are very strong prices we've seen not too long ago, and I would say certainly between 2006 to 2013. I think it'd be unrealistic to expect that sort of pricing unless we're seeing some sort of production challenge in some very important production region of the world. But other than that, I would do expect that the pricing we're seeing is probably what we're going to have to work with. The Canadian dollar helps quite a bit, and if we're able to grow our productivity, we'll be able to grow receipts, and I would say that this would sustain farmland values where they are. Really, the key moving forward is, are we going to be able to sustain farm income? I have every reason to believe that we'll be able to do so, but that's certainly something that I'm going to keep an eye on. And in the meantime, if we're looking at years of growth that are likely to be different than the recent past, then it's always a good thing to brush up on your farm financial management skills. And just as, yes, this is a bit of an advertisement, but I think it's actually useful to point out that in the month of March, we ran on our blog on the fcc.ca website. You can find on our blog rather easily. You can find a series of blog posts, one every week, that addressed one particular angle of farm financial management. I know that, or I strongly suspect that for the folks that are attending this webinar, this is something that you are going to be familiar with. That you know what a debt to asset ratio is, you know what a working capital ratio is. But I think just to read about this and look at some of the forecasts we have for some of these ratios, think about where your business stands compared to the average of the industry, those type of things. I think it's never a bad thing to actually look at yourself and say, all right, where's my business heading? How do I compare to others as well? And that sort of brush up your skills of farm financial management that I think are going to be really important given some of the tightness in margins that we expect in the short term. So having said that, I think I've done almost what I expected in terms of timing. So I'm going to turn it over to you, Matthew, and